All right, I want to get this video out be, early today, and especially before the FOMC meeting. I think I'm making a mistake being too cautious with the metals. I've been assuming that resistance levels were going to turn price back, and assuming that we're going to get normal cycle declines. And I said months ago that I thought this second day or second intermediate cycle was going to be very different than this first one here. It was going to be much easier to trade, and here is the start of this intermediate cycle, and it's doing exactly what I was anticipating that it was going to do. It's just going to be a lot easier to trade, much stronger trending move. But I think we're we've had basically 6 years of building this base. So traders, metal traders have just become conditioned to expect disappointment, to expect difficulties, frustration. And I think we're making a mistake by not adapting to an environment that I think is rapidly changing from what it has been. Um, here's the baby bull, and then gold has been kind of fell into this very difficult, very frustrating sideways basing pattern, and I think most everyone is still, the memory of this is still very vivid, and we all just expect that this is going to continue. So we're moving into resistance here, and we all expect that it's going to just turn back down, drop into a normal daily cycle low, and I'm now starting to question whether or not that is a mistake, and maybe a huge mistake. Um, Zoom in here. So right here, I think it was on the 6th, the dollar started to rally. And in it, any period during the last 6 years when the dollar started to rally, gold would start moving down. But look what gold has done right here as the dollar has rallied. It's definitely not moving down. It's actually still moving up slowly, more or less just in a sideways consolidation. And you can see we've just had multiple attempts to break through this resistance here at 1350. As I've been saying, I'm pretty sure one of the big bullion banks has gotten stuck on the short side, and this has all the earmarks, especially right in here, of a short squeeze. And this is their last chance to get out of this short. And they're just not really able to knock gold back down. So far, they've been able to prevent it from closing above this resistance zone here, but they're not getting any kind of big turnaround. And the bigger picture is we've got this cup and handle base. We got a breakout from the handle. I think we've got a short squeeze in progress, and I think it's a mistake to be cautious right now. I'm going to say if we get an attack on the FOMC meeting and they hit gold after the FOMC meeting, I think you probably want to buy that attack, because I suspect it's going to reverse into the close or reverse tomorrow, and then gold is going to close above this resistance zone here, and it's going to start knocking at the door of this higher resistance zone, and it may just go right through it. And the bigger picture, is we've just got this huge 6-year basing pattern, and we've got gold nearing the upper resistance zone of this basing pattern, and it's doing it very early in an intermediate cycle, potentially with a big bank caught in a short squeeze. And I think the risk right now is that we could bust through this. You can see how many attempts we've made at breaking through this, and we're setting up for another one, and this one may do it. It may break through it, and when it does, there's just no resistance between here and here, which is about 1500 to 1550, I guess I would say. So a breakout from this huge base could very quickly shoot up to this 1500 to 1550 level, and catch a lot of people, you know, out of the market. Um, the risk is that we get caught in a daily cycle low, but how much risk is that really? You have to ask yourself. We're in the advancing phase of a new intermediate cycle. During the advancing phase, markets tend to not stay oversold very long. Basically, once the 5-day RSI hits oversold, and usually it uh, bounces off that level like a hot potato, and immediately starts the next rally. So I think I think the risk is that we get caught in a very short-term daily cycle low that's not going to last very long anyway. And once it's over, then we probably are going to break out of this level, and um, the risk of not being in the market is that we shoot right through this and begin a very powerful move up to 1550, and it catches everybody out of the market because they were too nervous about getting caught in a minor short-term daily cycle decline, and then they end up getting left behind. So uh, I think you should be in, at least unleveraged. I don't think you should be terribly worried about getting caught in a daily cycle low. It's probably going to be over with very quickly if you do. And I think this intermediate cycle, I think it is going to break out of this consolidation box. I think it is going to at least test this 1500 to 1550 level. And I think you just want to make sure you don't miss that, and maybe not worry so much about getting caught in a daily cycle low. Worry more about not missing the move to here. So, I've said this many times in the past. Difficult markets are usually followed by easy markets, and we have had a very difficult market for 6 years, and we have all the indications now that we are entering an easy market. I don't think we want to make the mistake of not taking advantage of this um, unfolding easy market environment that I think is going to take us, at least up to 1500.